Hello and welcome to the January edition of my market newsletter. Welcome to 2025. Each month I just keep finding there's an abundance of noise and confusion in the financial markets, and that most Americans just don't know how to cut through the noise and get the data they're really looking for to make informed decisions. So because of this, I've created this newsletter where each month I put together a summary of thinkings to help educate long-term decisions. Now before we get into it, I do want to say, because of the increased regulation and compliance in the financial industry, I'm going to start with saying everything in this newsletter that you're going to see or hear is based on my opinion and is not predictive in any way. So with 2024 now in the rearview mirror, I'm happy to report on another positive investment year. Like all years though, we need to be long-term and financial plan focused as opposed to the shifting sands of unpredictable investment returns. So this idea is of course going to be the same here in 2025 and in each year that follows. But twice a year, I do like to just pause for a moment, typically in January, then like June or July timeframe. About twice a year, I want to restate some of the core beliefs that we all should be following. So the first item is going to be general principles. And that the idea is that we're going to be long-term, goal-focused, and planet-driven investors. This means we start with a financial plan for each client. And that we want to create broadly diversified portfolios that is central to investment policy. And then we also have to admit that the economy cannot be consistently forecasted and the markets cannot be timed. And so because of this, the only practical way to capture the long-term but historic positive investment returns is to ride out the frequent but historically short market downturns. And so to put another way, there are no facts about the future. I wish there was. And that as your long-term financial goals change, so should your investment allocation. Okay, these are the general principles that I want to make sure that we're all adhering to. The next item here is going to be looking at the 2024 and 2025 comments, and that the investment returns in 2024 were really largely fueled by a handful of technology companies. Okay, one such company, which I won't name, close to tripled its stock value in 2024. And that the basic economic backdrop continues to be favorable with a strong job market. Although we might be seeing signs of cooling off with the Federal Reserve, corporate earnings and dividends reach high levels in 2024 and are forecasted for another great year. Current valuations are high when compared to longer-term averages. Our valuations have not proven to be a historically accurate indicator of market returns, so don't get too excited about market valuations. Inflation, this is a tough one. It's sticking around longer than anyone really thought. And Jerome Powell recently talked about how he doesn't think this is going away soon. Since March 2009, the S&P 500 has enjoyed an annual return of close to 16%. But I do want to make sure we recognize this trend line is not the go-forward expectation. And that finally, I never want to forget or lose sight of the intense volatility of the markets. And that in just 2020, the market dropped by 30%, about 30 days. And in 2022, with high inflation, the market dropped another 25% over a 10-month period, and that between 2007 and 2009, the S&P 500 dropped by about 50%. Okay, but some more data points on 2024 as we're moving forward here. One is that in 23 and 24, the S&P was up over 25% in each of those years. Now, using history as a guide, this has happened only 3 other times since 1928. It was in 1935 and 1936. The market was up over 25% each year. 54 and 55, again, 25% each year. And then in 97 and 98, again, 25% or more in each year. But the next question is the common one. Okay, so great, that's what happened 2 years. So what happened in the year that followed, right? Well, this is where we get a little bit of everything. Because in 1937, of course the year here, the market was down 35%. In 56, we were up 7%. In 99, we were up 21%. In that it's really important that we always keep in mind that the great years like 23 and 24 typically come on the heels of a really bad year or terrible year like in 2020, with it down being close to 25% at one point. And that when these up years historically have outpaced the down years. And this is why we have the 30-year plus long-term S&P 500 averages of close to 10%. Okay. And that when thinking of back-to-back great investment years, yes, it is common to think, why don't we just have a 100% allocation to the S&P 500? You wouldn't believe how often I hear that. Let's just put it all in the S&P 500 because, heck, the S&P 500 is about at 6,000 with annual returns since 2009. Even Dave Hughes set up about 16%. But you all know the thought process here. And let me share where most people get the cart before the horse, because someone who buys the market today, you know this, does not get any of the historical return. And that someone who buys today is buying into the market with a historically high valuation, close to 22 times the next 12 months forecasted earnings. Okay. So let me just unpack this here. When we talk about the PE ratio, right, per price earnings ratio, this number being now at 21.5%, this is saying the valuation is 22 times the next 12 months forecasted earnings. Okay. And you can see how high on a historical level this number is. Now, I'm not saying the market's going to go up or down, from this. As I just said, in fact, valuations has been a really poor indicator of future returns. Okay. But I want to remind everyone of what Warren Buffett said about this, and that the investor of today, so if someone has $100,000 in cash and then puts $100,000 into the market writ large today, the investor of today does not profit from yesterday's growth. And that this idea is one of the reasons it can be so hard to implement a disciplined investment strategy and disciplined diversification strategy. Because keep in mind, the proof point of diversification, the proof point is knowing that some of the portfolio is going to outperform and some of the portfolio is going to underperform. Okay, now last word on this, and that when building investment portfolios, it is critical to remember not to own enough of something to make a killing in it, because if you do, you also own enough to get killed by it too. Okay, now I said last word, but here's the last data point, all right, that I want to share on this. And this is a chart that I've shared numerous times before, and every time I share it, I like the fact that I'm sharing it. And it shows the regularity of market declines, because I want everyone to remember how common it is for a 5% market decline, a 10% market decline, 15, 20% market decline. All very, very, very normal items, okay? Now, switching gears into the additional data section. Each month I get asked by clients what additional resources I'm looking at. And please hear me in saying I'm not trying anything predictive whatsoever. These are just some of the interesting data points. If you scroll down on my newsletter, you're going to see one of them titled Tariffs. All right. And tariffs is really about just, the understanding that I do not understand the tariff idea that President-elect Trump is touting. Because to me, a tariff is simply a tax that gets passed down to the consumer, people like you and me. And there's an article I'm referencing by someone much smarter than myself named Warren Coates, who summarizes this simplified view. But it really does drive home the point where I'm just not seeing eye to eye about the tariffs. Okay. Next data point is saying is really being able to answer the question, or just be able to harp on this a little bit. It's a common idea about what happens when or if China starts selling U.S. debt. Okay, it's a question. It's recently posted to me by a friend, right? But this article and really the visual that we have here on the screen now from Visual Capitalist does a really wonderful job of putting this into perspective. You can see U.S. has a lot of debt, way too much debt in my opinion. But when you look at who holds the debt, 2% is China, right down here. 2% is United Kingdom, right? 3% is Japan. And you can see the vast majority, okay, is domestic based. All right. Again, still see way too much debt. I don't have that large of a concern about China selling its debt. Also, when it comes to pricing on the debt itself, but we'll see. Next data point is something we've been tracking here for a while now. It's looking at all the money in money market funds. This number just continues to tick higher and higher. I am very surprised by this. We're now at $6.8 trillion. It's the highest level ever reported, right? And so the idea is that these dollars right now are enjoying higher levels of interest than in years past. But then if we think the Federal Reserve will start to cut interest rates and banks pay less on interest on these accounts, do we really think people are just going to hold these funds? My guess is people won't just hold these funds if interest rates do come down. Okay, another data point been tracking for a while is break-even inflation rate. Break-even inflation, gosh darn, this chart is now going back to 2004, maybe 2003 or so, and you can see this long-term average, this 2% trend line right here. How this goes out, I mean, goodness gracious, it looks really good right now. The Federal Reserve balance sheet. Again, this is another long-term tracker that we have here. I'm very happy to report that here at $6.8 trillion, we're now at the lowest level since May 2020 here, which is wonderful. Then the last data point I want to look at, this one continues to inch up, unfortunately, as well. Debt interest payments, right? So most people in our country would agree that the federal debt is just too high, but not people realize that the interest payments just the interest payments, are now over $1.1 trillion a year. What should we do about it? Well, no one's really asking me, but my guess is that we should balance the government budget. But no one's asking. Okay. So in closing, we of course cannot control what the market does from here. And we cannot predict when the next market downturn will occur. But what we can control is our behavior to these outside events and continue to stick with our long-term investment strategy. So in closing, I hope you have a fantastic start to 2025. If you have any questions whatsoever, don't hesitate to reach out. Thanks, and talk to you soon.